Welcome once again. This is Pinnacle Professional College. And as I already promised, we are going to be continuing our series on corporate governance. We touch on what corporate governance is, the difference between corporate governance or governance and management. And then we moved ahead to talk about the separation between ownership and control. Now we got to the problems arising from the separation of ownership and control. And we basically talked about the fact that sometimes the directors that you put in place might not be acting in the interest of the shareholders. And that's one of the key problems when it comes to the separation of ownership and control. Now let's continue to the fourth bullet point. When the shareholders of a company are also its directors and there's no separation of ownership and control, problems with corporate governance are much less likely to arise, right? So when there's no separation between ownership and control, then you don't really have any problems, or you have less problems when it comes to the separation of ownership and control. Problems with corporate governance generally arise when a company has many different shareholders and there's no majority shareholder, right? So the problems become worse when there are a lot of shareholders and there's no majority shareholder, right? And why is this? Why is it that when there are a lot of shareholders, the problems increase? Because you would have to identify the interest of all these shareholders as a management team to be able to fulfill them. Now, if you are not able to fulfill them, then that creates problems of tension. So when there's typically no majority shareholder, you do not know where to focus your key efforts on. In these companies, the board of directors have extensive powers for controlling the company, but the shareholders are relatively weak, right? So in companies where there are a lot of shareholders and there's no majority shareholder, the board of directors would have extensive powers for controlling the company, but the shareholders will be relatively weak because they do not have they do not have like a lot of aggregation in terms of their power and their efforts. So for instance, if there's a majority shareholder, the majority shareholder or majority shareholders can run or influence things. But if there are a lot of shareholders with, tiny portions of the business in terms of ownership, then they become relatively weak. Right? The directors ought to be accountable to the shareholders for the way they are running the company. However, in practice, the shareholders might have little or no influence and do not have the ability to prevent the directors from running the company in the way that the directors themselves consider to be best. So this is another challenge when it comes to separation of ownership and control. Managers are given the ability to run the business, right? And shareholders only own the business, right? If the shareholders find out that managers are not running the business in a certain way that they love to see, it's difficult for them to prevent the directors from running the company in a way that they deem not fit. It's difficult because managers are given that leeway to manage a company, and practically it's quite difficult for shareholders to prevent directors from running the company in a certain way. It's very, very important. Very, very important. Now, let's move on to approaches to corporate governance. Ownership and control in non-corporate entities. The separation of ownership from control can affect the quality of governance in non-corporate entities as well as companies, right? In an entity, it should be possible to identify owners and controllers. In every entity, you should be able to identify it. You should be able to see, okay, who are the owners and who are the controllers. So if you pick a company like Barclays Bank, you should be able to tell, okay, these are the owners and these are the managers or controllers. The owners might be the government or the public. It's possible. There are situations where the owners are the public, right? The owners are the government. In the case of a charity organization, the owners might be a section of the public. So different types of businesses would determine who the ownership will be. For a public organization or institution, the owners might be the government or the public. Now, let's talk about those in control. The power to govern a non-corporate body might be given to a management committee. A management committee. That's why you would hear more often about the Ghana Football Association. There's a management committee. The power to govern a non-corporate body might be given to a management committee. Appointments to the management committee might be made by the owners or by means of a procedure that is specified by the Constitution. It's very, very important. Now, don't forget that we are focusing on non-corporate entities. Non-corporate entities. So you are looking at entities like charities, you are looking at entities like NGOs, we are looking at entities like government bodies, we are looking at entities like public entities. These are non-corporate entities. It's very crucial. And for these, the power to govern that non-corporate body is usually given to a management committee. The management committee is appointed by a process. They are appointed by a process, and this process is specified by the Constitution or the constitutional rules. It's very crucial. This is very, very important. It's very, very important. So the appointments to the management committee might be made by the owners, either the owners or by means of a procedure that is specified by the constitutional rules of the entity. Now let's look at corporate governance. Corporate governance. Corporate governance laws and guidelines, right? It is well recognized that there is good governance and bad governance. By now, you should know that there is good governance and there is bad governance, right? Bad governance occurs when an entity is governed in a way that is inconsistent with certain concepts and practices, right? So let me explain. This sounds like a generic definition, but let me explain. So when we say there's bad governance going on, it simply means that the company is being governed in the interest of the directors rather than in the interest of owners. Right? It's very, very important. So when the company is being governed in the interest of directors instead of the interest of owners, then that's bad governance, right? It means that the company is being governed in a way that is inconsistent with the laid down concepts and practices. Or it's being governed not according to best practice. It's being governed not according to best practice. It's very, very crucial. It's very, very important. Very, very important. So what would be good governance in that sense? Good governance is based on certain key concepts and practices, which we can describe later, right? We'll talk more about it later. But when you see good governance follows key concepts and practices, and it's designed to be in the interest of shareholders. You know, good governance is in the interest of shareholders, because at the end of the day, that's what you want. That's what you want. So let's touch on a few concepts before we move on to another slide in our next lecture. First of all, we need to understand ownership and control in non-corporate entities. Non-corporate entities are basically entities like NGOs, charities, public institutions, government bodies, etc., right? And for those, the power to govern those non-corporate bodies is given to a management committee. And the appointments to the management committee is done sometimes by the owners or by a certain specified constitutional law. Now, we distinguish between good governance and bad governance. Good governance is in the interest of shareholders and bad governance is not. So this is where we would end this lecture. We would continue in the next slide in another lecture. If you haven't subscribed, please do so. Thank you for watching. Have a good day.